$50 Swiss.
Wall Street, New York City, 1980. The United States is in a recession. Currency traders try to squeeze a margin of profit, closely watching central bank decisions and the moods of markets. Just a few miles away in the South Bronx, their fellow Americans languish in poverty in crumbling buildings. Unlike the traders at the other end of the subway line, joblessness and inflation here aren't chances for profit, they're reasons for misery. The Federal Reserve Chairman at the time, Paul Volcker, saw raising interest rates as the only way out of the spiral of unemployment and high prices. The decision deepened the recession for a time, but it ultimately succeeded in rescuing the dollar and returning the economy to growth. Federal Reserve Chairman Jerome Powell can only hope he's so lucky.
We're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. Our banking system is sound and resilient with strong capital and liquidity.
Powell has different problems than Volcker did, and 40 more years of Fed history to contend with. His predecessors responded to recessions and extraordinary events by slashing interest rates. After the September 11th attacks, during the subprime mortgage crisis of 2008, and again in 2020, as the pandemic shut down the global economy. The beginning of 2023 saw the collapse of several regional banks in the US, but the Federal Reserve is not responding by cutting rates. Powell blames one of them for not preparing properly for an era of higher borrowing costs.
Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk.
Analysts generally agree that a 2008-style global financial crisis is unlikely, where the implosion of over-leveraged banks drove U.S. unemployment into the double digits.
Majority of banks will be okay. It's really the specialized banks and banks that cater to the high net worth that have a little bit more concern. But this, at least so far, this is not 2008.
Powell suggested an end to rate rises is near, but those rates could stay higher for longer. How long they remain so, however, is anybody's guess. Wilson Dizard, TRT World.
Let's get some analysis on this. Dahar Vas is an adjunct professor of finance at Dizard University and joins me here in the studio. We also have Jeffrey Tucker, president of Brownstone Institute, dedicated to social and economic research. He joins me now from New York. Jeffrey, I want to start with you. Janet Yellen remarks this week have really scared investors away, as she said there was no blanket guarantee, meaning any move to broaden deposit insurance, essentially. Has the dust settled yet on this sector, or will we see more turmoil in the coming days?
There's more dust and dirt than ever. She the other day promised universal bailouts and then is trying to dial that back because that directly contradicts Federal Reserve policy. So we have really two monetary policies running at the same time, one hawkish and one dovish. So you've got Powell out there raising rates under the belief that there is a terminal rate that he's going to raise short-term rates ahead of existing inflation rates, and that's somehow magically going to kill inflation, and that is his central concern. That's really all he cares about, because he wants to be the new Volcker. So and reverse Bernanke's policies that began in 2008. So that's the goal, which means more and more and more increases, because we're nowhere near that point. We're still in negative territory. You know, we have to remember the federal funds rates are still negative by about 2%. So he's got a long way to go, even to get positive rates in the short term. Meanwhile, Janet Yellen, yammering around, goes on about how we no longer have limits on deposit insurance in this country. And then in her testimony this week, she testified before the Senate on March 22nd and said the banking system is sound, and then otherwise went on with her testimony. The very next day, she reprinted the exact same testimony while leaving out that sentence. You know?
Absolutely.
So that doesn't calm markets down. When you take out a sentence that says the banking system is sound, you take it out of your testimony the next day. That's pretty worrying.
Right.
So yeah, nobody knows what the policies are right now, and in terms of the moral hazard she's unleashed, it's really unspeakable. I really do think this week needs to go down in the history of monetary economics as really one of the great calamities.
Right.
It's a potential disaster.
Absolutely, possibly not a great way to settle that dust, right, Taha? And I
Right.
do want to, across the pond, I do want to ask you a question on Credit Suisse as well, because certainly the dust hasn't settled yet on that front. I mean, we know
Right.
that bondholders in Credit Suisse, they now are suing the Swiss government over its decision to write down completely the value of at least those 81 bonds, right? What's happening there? What are the consequences of that?
Well, I think the Swiss government, rightfully so, in concert with, we heard Jay Powell talk about it during his testimony, is trying to do whatever they can to calm nerves, right? We're here. What's interesting is Switzerland is one of the, probably the only example of an economy where the central bank is so strong that Switzerland really doesn't have a problem. It could very easily have saved, and it did de facto save Credit Suisse. It could have acted faster. What we're seeing on the European side is, unfortunately, this very relatively much less proactive actions. They're much slower. The weekends are much more important, apparently, to European government officials. But we saw today with Deutsche Bank something similar. So if we're seeing a series of unforced errors, right? Yes, it's a calamity, but all of these things could have been avoided. We just talked about Janet Yellen and how she made that a huge fumble, and today with Deutsche Bank. So what they're trying to say in general is the banking sector is strong, but they're saying it slowly. They're making mistakes when they're saying it. The PR game is completely off. And right now, sentiment is what's important. And that's what markets are looking for.